Ivy Zelman just released her biggest warning yet. The analyst who called the 2007 housing top, the woman Wall Street nicknamed Poison Ivy for being right when the entire industry was wrong, is now telling homeowners, buyers, and every real estate investor in America that home prices are about to dip. On September 11, 2025, she sat down with CNBC's Diana Olick and delivered the forecast that sent shockwaves through Wall Street housing desks. Home prices will dip in 2026 before rebounding in 2027. And when the analyst who saw 2007 coming tells you something is about to break, the writing is on the wall. Every homeowner, buyer, and real estate investor needs to pay attention. Here's what we're going to show you in this video. Number one, the 3 national numbers that just landed this month that prove Zelman's dip is already happening in real time. Number 2, the exact list of metros where prices have already dropped by double digits, and one of them might be your city. Number 3, the manufactured stability propping up this market that almost nobody's talking about. The exact trick Zelman herself called out on the record. Stick with us because by the end of this video, you're going to know exactly where home prices go from here and what to do about it. Let me set the table for you. Ivy Zelman is not a doom merchant. She's the co-founder of Zelman & Associates, now a Walker & Dunlop company, and she's the single most credentialed housing analyst on Wall Street. In the summer of 2005, when every builder CEO and every housing bull on television was screaming everything was fine, her team published a report called Investors Gone Wild, and she called the top of the housing market. On a 2006 Toll Brothers earnings call, when CEO Bob Toll insisted the market had bottomed, Zelman famously asked him, "Which Kool-Aid are you drinking? Because I want some." Months later, subprime lender New Century, which had issued $51.6 billion in subprime loans in 2006, filed for Chapter 11 bankruptcy. That was the beginning of the end. And here's what most people forget. She also called the housing market in January of 2012. She's not a perma-bear. She sees what the data sees. Institutional investors ranked her team the #1 housing research shop 11 times. Michael Lewis credited her research in The Big Short. So when Ivy Zelman gets on CNBC in September of 2025 and tells Diane Olick that home prices are going to dip in 2026, folks, this is the single most credentialed bear call in all of American housing right now. And here's why she's saying it. On the Walker webcast with CEO Willie Walker in January of 2026, Zelman laid out the exact thesis. Her words, "We have a shortage of affordable available homes, not a shortage of homes, a shortage of homes people can actually afford." She revised her firm's 2026 rent growth forecast down to 1.9%, citing prolonged oversupply, particularly in the Sun Belt. She said the stuck factor, the lock-in effect keeping homeowners with sub-5% mortgages frozen in place, peaked around 90% in 2022, has already fallen to roughly 72%, and is on track to fall into the high 50s by 2027. Translation: the frozen sellers who held prices up for 4 straight years are starting to thaw. Life events force movement. Divorces, deaths, job changes, new babies. And when frozen sellers thaw at the same time affordability is stretched to record levels, with the Freddie Mac 30-year mortgage at 6.49% as of July 9th, and Fannie Mae forecasting rates stay above 6% through 2027, prices dip. That is Zelman's thesis in one sentence. Which brings me to the first thing I promised you. The 3 national numbers that just landed this month that prove Zelman's dip is already happening. Number 1, the S&P Totality Case-Shiller National Home Price Index for April 2026, released on June 30th, came in at just 0.8% year over year. That's not growth. That is a market gasping for oxygen. And here's what almost nobody in mainstream housing media told you. When you subtract inflation, the Case-Shiller Index has been negative in real terms for 11 straight months. Real home prices in America, the ones that measure your actual purchasing power, have been falling since May of 2025. S&P's own head of index research, Nicholas Grodek, called the numbers essentially flat. Number 2, Realtor.com's June 2026 housing report, released on July 1st, showed the national median list price fell to $430,000, down 2.5% year over year. That's the steepest annual decline since 2017 and is the 8th straight monthly drop. Chief economist Danielle Hale said sellers are now pricing accordingly from the start rather than listing high and cutting later. Translation? Capitulation. And Redfin confirmed it. 35.4% of sellers cut their asking price in the latest reading near a record high. Number 3. The FHFA House Price Index for April, also released on June 30th, was down 0.1% month over month. The Mountain Division was down 0.8% in a single month. When federally tracked home prices go negative on a monthly basis, that's not noise, that is a trend. Case-Shiller flat. Realtor.com steepest drop since 2017. FHFA negative month over month. 3 separate primary sources, 3 separate methodologies. All saying the same thing. Zelman was right. The dip has started. Real quick, if this market intel is helping you make better decisions, hit that notification bell. We drop new housing data every week, and the viewers who catch it first get the best opportunities. The bell ensures you see everything immediately, not days later when the market's already moved. Now, let's get to the second thing I promised you, the metros where prices have already dropped by double digits. Because if you live in one of these cities, this video just got personal. According to Resi Club Analytics' June 2026 update, 77 of the 300 largest housing markets in America are now negative year over year. Among the 50 largest metros, 22 of them, 44%, are in the red. And the Austin, Texas metro is now sitting 27.3% below its 2022 peak. Do the math with us. A home that peaked at $550,000 in 2022 is now worth roughly $400,000. That's $150,000 in equity gone. And Zillow's 2026 forecast has Austin dropping another 4.6% over the next 12 months. Zillow's model also has Houma, Louisiana down 7%, Lake Charles down 5.6%, and New Orleans down 4.4%. In the year through October 2025, values fell 6.1% in both Austin and Tampa, 4.8% in Miami, 4.6% in Orlando, and 4% in Dallas. The Case-Shiller 20-city report for April showed Seattle down 2.3%, Denver down 1.8%, Tampa down 1.8%, Phoenix down 1.7%, and Dallas down 1.6%, all year over year. Meanwhile, Chicago is up 6.5%, New York up 3.8%, and Cleveland up 3.2%. Cotality, formerly CoreLogic, confirmed the same split. 72% of the largest 100 metros are now overvalued, and 10 states showed negative appreciation in May. Here's what's interesting. This is not a national crash. This is a two Americas correction. The Sun Belt and Mountain West are bleeding. The Midwest and Northeast are still gaining. If you live in Austin, Phoenix, Tampa, Cape Coral, Dallas, Seattle, or Denver, Zelman's dip is not a forecast. It's your listing agent's problem with this month. Which brings me to the third thing I promised you. And this is the one that changes how you think about every single housing headline you've read in the last 12 months. The manufactured stability propping up this market. Zelman said it herself on the Walker webcast. More than 90% of new home sales in America right now are spec homes, supported by aggressive mortgage rate buydowns. In her words, the buyer cannot qualify without rates being reduced below 5%. Read that again. The new home market is being kept alive by builders paying to lower your interest rate. Take away the buydowns and the buyers vanish. D.R. Horton, the largest home builder in America, just confirmed it. In their Q2 fiscal 2026 filing with the SEC, they disclosed that approximately 90% of their mortgage customers used a rate buydown. Their home sales gross margin fell to 20.1%. Lennar, the second largest builder, saw margins collapse to 15.6%, down from 17.8% a year earlier. Their average sale price fell 5% year over year to $371,000. CEO Stuart Miller cited persistent elevated mortgage rates, constrained affordability, and cautious consumer sentiment. The NAHB Housing Market Index hit 35 in June of 2026, the 14th straight month below 40. That's the longest sub-40 streak since 2011 and 2012. The foreclosure crisis. 35% of builders are cutting prices. 62% are using sales incentives. the 15th straight month above 60%. And here's the kicker. Intercontinental Exchange Mortgage Technology reported that the active foreclosure inventory hit 280,000 in May 2026. That's up 34% year over year, the highest level in 6 years. Their head of mortgage research, Andy Walden, pinned the blame directly on FHA loans. FHA serious delinquencies are up 105,000 year over year, the largest annual increase since 2020. Adam Data Solutions confirmed foreclosure starts rose exactly 20% year over year in Q1 2026, and bank repossessions were up 45%. And here's the really alarming part. Wait, it gets worse. Because the picture the mainstream media is showing you, flat national prices, homeowner equity at record highs, only 1% distressed sales, is the picture of a market being propped up. Builder buy-downs are hiding real demand. The lock-in effect is hiding real supply. And FHA delinquencies rising by 105,000 in a single year are hiding the beginning of the credit stress. Here's our controversial take. And we'll die on this hill. The flat national headline is a lie of composition. In 2026, America will post a modest national nominal dip, exactly the Zelman call, while a growing list of Sunbelt metros extends double-digit peak-to-trough declines. This is not 2008. Only 1% of sales are distressed. Homeowner equity is elevated. This is Zelman's grind scenario, a bifurcated correction that punishes overbuilt metros and rewards patient buyers. Every single piece of data we just walked you through backs it up. And Fannie Mae's own Economic Strategic Research Group agrees mortgage rates hold above 6% through 2027. This is the most defensible bear call in American housing right now. And it's coming from the one analyst who has already been right once. And right on the way back up, too. So here's exactly what this means for you. If you're a seller in Austin, Tampa, Phoenix, Cape Coral, Dallas, Seattle, or Denver, and you actually want to sell in the next 12 months, price aggressively now. Every month you wait in these markets is potentially a lower price. Austin sellers have already lost 27% from the 2022 peak. Waiting has cost real people real money. If you're a buyer, be patient and be smart. Understand the data in your specific metro before you make a move. In the declining markets, you now have negotiating leverage you haven't had in 5 years. Ask for builder buy-downs. Ask for price cuts. Ask for closing cost credits. Ask the builder to eat your closing costs and give you a 5% rate. They will do it. And do not let a listing agent convince you the market is about to rebound. The most credentialed analyst in housing just said the rebound doesn't start until 2027. And if you're a homeowner who bought before 2022 with a sub 5% mortgage, you are Zelman's stuck factor. You're not selling. You're not moving. And here's the honest truth. You probably shouldn't. Your equity is real. Your rate is a gift. Ride out the dip. Bookmark this video, come back in 6 months, and check every single number I just showed you. That's how confident we are in this data. And if you want to be first to see where these numbers go next, make sure that bell is on. We'll see you in the next one.